And live at the Chicago Mercantile Exchange, Michael Gurka of BruinHill Partners, who correctly predicted the low for the Dow back in 2009. Also back with us, Hans Olsen, Chief Investment Officer of JPMorgan Private Wealth Management, where he helps manage $120 billion in assets. Last month when he was here, he said the markets would trade on headline flow, which, given the environment we were in, would be difficult, and that's exactly how it played out. Hans says now is the time for investors to sweat the small stuff. I'm going to ask you about that. What small stuff? Seems like it's a lot of big stuff.
Yeah, it is a lot of big stuff. And it's everything from the stress tests that are going to be released in Greece next week. It's the particulars of FinReg. It's how healthcare ends up getting implemented. So it's a lot of the small things that are easy to overlook that are going to have an increasingly important impact on investor attitudes and willingness to invest as we roll forward.
What do you make then of the rally? I mean, investors kind of overlooking that, at least for the moment.
Well, I think we're back to the earnings season, thank God, because now we can at least digest some hard numbers, and it's been a long wait till this earnings season, right? The last 8 weeks or so, and the early indications right now are pretty good, right? I find it interesting last night that you had everybody focused on Alcoa. But yet CSX and Novelis reported both really good numbers. Right. So directionally headed where we needed to go.
What's interesting, CSX, and Julie brought this point earlier, the stock's down to 1.4%. So even though some decent numbers, right?
It's still on the good news, right?
It's interesting. Hey, Michael Gurka, I want to bring you into this because we do have a rally underway. We are seeing CSX shares lower. They did have good news. Does that kind of surprise you to see how that's playing out?
Well, you know what? The infrastructure plays were clearly something that people were looking at over 6 months coming into the last earnings season. And now, lo and behold, here we are looking at technology again. And maybe the expectations are going to be even exceeded once more. I've been looking at 2-year charts, in particular on the NASDAQ. And what's happened is that 50% retracement from 2007 to 2009 came in at 2063. And over the last 2 weeks, we did form a double bottom and did not take out that level. So lo and behold, now my target is now 2251 to the upside if we continue to get this bullish news like we've already priced into the market.
And a great question, whether or not the earnings momentum can continue. Hans, what do you think?
I think so. I mean, for Q2, the expectations are we'll see earnings growth something like 27%. More importantly, though, Carol, the quality of the earnings need to increase, and from that angle, expectations are we'll see revenue grow somewhere on the order of 7 to 9%. So I think for this quarter just passed, there's going to be good news there. I think the important thing that we focus on is sort of what's the nature of what management is signaling. Are they signaling a more robust future, something better than we've had? Yeah, exactly. More and more emphasis is going to be placed on the outlook.
Michael, it's Dominic here. I want to kind of ask you something here because the market closed right at 1095, and a couple traders told me this morning they were looking at that level because it's the 50-day moving average, or the short to medium term batting average, if you will, for the marketplace. How important are these moving averages or technical patterns here as opposed to what's going on with the earnings season coming up here?
You know what, actually, I think the last time we spoke, we were talking about that same exact moving average, but it was up at 1104, and lo and behold, we've been pulling back. One of the surprises for me would be is if the market was not reacting the way it is, considering the DAX is up on the year, it's performing very well, the Euro's trading at 127 now in an upward slope, and last but not least, crude oil is starting to rally. Now, if you have a divergence on one of those 3 components, and the S&P does not turn around, then I'm starting to see either an asset allocation shift, or more importantly, what I'm anticipating is in the middle of this earnings season is you're going to start seeing some large put buying, probably in the ETF space, that shows if we have some disappointment, it could be abrupt and volatile. And right now, at least, we've been starting to see a little bit of that nature in the S&P, but on those other extraneous situations, we've seen none of that yet. And again, that slope is up. I would keep an eye on the DAX. I think that's something that no one's looking at, up 4% on the year, and has really performed well concerning how bad Europe has been.
Hey, Hans, it's Julie here. We've been talking about this low volume situation. Do you think that earnings are really going to be the catalyst that's going to get people back into the market, or are we just in the summer doldrums here and people are waiting beyond this earnings season?
You know, Julie, I think it's part of a bigger issue that the market is dealing with right now. The first is it's a debate as to what's the engine of growth and how powerful that engine will be. If you look at it on the earnings front, the engine sort of feels more like a Ducati motorcycle engine versus from the economic side, it's more like a Vespa, you know. So
we can relate to that.
You can relate to that, yeah, from what I gathered last week. But the reality is that it's part of this robust debate going on is which one is going to prevail, and it's an interesting dichotomy right now. On the earnings side, it's very good with large publicly traded companies. Economic numbers are still kind of punky, and as we saw today with the small business, still, the small business people it's hurry up and wait for people to show up at their door and buy their goods and wares.
And Hans, Michael, let me, Michael, get you to weigh on this. I mean, are the expectations for earnings just too high at this point? I mean, up 12%, as Adam was just pointing out, not bad, but everybody was looking for 14%. Are the expectations when it comes to some of these earnings expectations just too high?
Absolutely not. I think that history has proven, at least over the last 3 quarters, that they've literally earned this scenario of being where they are. This is not coming out of the doldrums. It's cleaner balance sheets. It's better scenarios forward. And Yum is a great example only because internationally really is where you're starting to see a lot of these multinationals get their growth, have larger percentages of their revenues come from that. It's the problem of domestic, much like the Vespa scenario that you talked about. We don't want it to turn into a bicycle where if you can't fuel it yourself, it's going nowhere. I think the earnings have earned this. It's the economic scenario really that is the only doldrum right now, I think, that keeps this back.
Well, that's a good point. I mean, we've been talking a lot, Hans, this week about that stimulus debate versus cutting the deficit. I mean, where do you weigh in on it based on what your outlook is for the economy at this point?
Well, here at home or globally?
Well, globally, but home is a big factor, of course.
Yeah, it starts at home, right? We're going to start to see in the second half the stimulus start to fade, right? I mean, we've known that for some time.
Starting to see it already.
Yeah, and you're starting to see it in earnings estimates on the part of analysts. They're starting to, the revisions are starting to roll over. The rate of growth is flattening out, so I think it's starting to get priced in a bit. So that shouldn't be news. On the foreign front, the austerity programs that have been launched throughout Europe are interesting. Some of them it's going to take years for them to implement, but directionally it's correct. And I think these days, if you're heading in the right direction, that's the first most important step. Magnitudinally that comes second, but you have to be heading in the right direction. And I think we're heading in the right direction there. We're starting to already discount the trail off in the fiscal. And rates can only go to 0 on the or maybe perhaps a new round of QE2. Right. We'll see.
Hey, 30 seconds left for you, Michael Gurka. We got a lot of earnings coming up and some big ones this week. What's the next focal point for you guys there down on the floor?
Well, I hate to just keep beating this to death, but everyone down here continues to look at Apple, and I think it's not so much that how well will they do or all these numbers that we've heard in the past on their sales, but actually if they do disappoint, how is the market going to react to that? Is that a buying opportunity? Because right now, at least, I believe you're starting to see a lot more buyers on dips than you have seen people selling on profits, and right now, at least, that's a surprise to me because I think profit taking is going to be the key scenario for the balance of this year.
All right, and for those of you keeping track, Apple reporting their earnings on July 20th. All right, we're going to leave it there. Hey, Michael Gurka, thank you so much. Hans Olsen right here in studio. Thank you, Hans.